Good afternoon, everyone. I'm Pamela Hastings and welcome you to another Barometer afternoon webcast. I'm located here in our Barometer South office. And today we have a couple guest stars, including Jim Shitakis, located in the Barometer headquartered office in downtown Toronto. And of course, as always, we have David Burrows, our Chief Investment Strategist and President at Barometer from the Midtown office in Tony Rosedale. With that, we have lots to talk about this afternoon. We are just nearing the end of the quarter, and we're heading into a summer here in South Florida, but as well all over the world. So things are getting quiet, but the market's been quite interesting to follow as of late. And David will talk to you about that. As I mentioned, Jim Shitakis is joining us. He's a portfolio manager and executive vice president with Barometer. So we're pleased to have him and his eyes on what he's seeing from a fund flow perspective and strategies in the market. So we're excited to have Jim join us today. With that, we will be addressing questions at the tail end of this conversation. So please send them to me via the chat or by email, phastings@barometercapital.ca. And with that, I turn the conversation over to David Burrows. Good afternoon, David.
Hi, Pam. How are you?
Well, we're great. Little puppy is recovering from being neutered, so he may have a cameo in the back. He's just resting on the couch. But otherwise, we're all in good spirits. So happy to be here and excited to come back up to Canada shortly.
Well, looking forward to getting you back across the border. Thanks everybody for tuning in today. We got a bunch of stuff to cover. As Pam mentioned, we're coming into quarter end. And quarter end is always a little bit of a funky period. There's flows taking place, some rebalancing taking place, people getting ready for, in some cases taking off to take some time away. So there's lots of cross currents, and there's been a little bit of news this week and some stuff to talk about. I've asked Jim to join us to talk a little bit about a few of the sort of market driving news pieces, and we'll go from there. So just to kick off, as we always do, we start with a view from 30,000 feet across asset classes, and our baseline view is we're in a structural bull market in equities, which was kicked off in the US in 2013 when we exceeded the highs from the previous bull market in the year 2000. And since then, one by one, markets around the world have joined the rally. A bull market, a structural bull market, is characterized by sort of 3 steps forward, 1 step back. It doesn't mean there aren't pullbacks, but it does mean that it's a more consistent ride. And generally, leadership is fairly consistent through a structural bull market. And so you can get focused and make a difference by targeting leadership. And that's what we spend a lot of time talking about. Outside of equities, we've been making a case that we've been going through a structural bottoming in yields in the bond market, much like the late 1940s, early 1950s. And that once you move into a reflationary environment, the sector leadership may be somewhat different than what works during a period of disinflation or falling long-term rates. And that's a topic of conversation that we've been focused on over the past year. And of course, we've also had a view that we were going through a bottoming process in the commodities markets after being through a structural bear market that started sort of in 2008. So that's 13 years. And that likely going forward, it looks a little better than it did looking backwards. And that's going to be an important thing from an asset allocation standpoint. Just to kick off on equity markets, here's the S&P. We've been putting this up regularly week by week. This is the little double bottom we saw last October, November, heading into the election. And then markets from there really have been in this channel pretty consistently since then, dipping to the low end, getting to the high end, and marking its way forward. And you can see over the past week, again, we've moved to new highs in the S&P. We'll talk a little bit about what might be driving that. This is the equally weighted S&P 500, also has been in this channel. You can see, though, actually in the last 2-3 weeks, a little bit weaker performance than the market cap weighted S&P 500. What might be driving that is some of the large cap growth stocks, which have had a nice lift after consolidating, for about 3.5 months. And some of the big cap names within the NASDAQ 100, have been making a difference. And that's always important to try and make sure that we're touching on all the bases. Certainly some of the big names that we're focused on, Microsoft coming in, making new all-time highs today, Adobe doing the same thing, NVIDIA. So some of these stocks acting very, very well and contributing nicely, making new relative strength highs versus the S&P for the year. And so one of the questions is, is this a growth or value market? Is it an inclusive market? Is the breadth good enough that we can take a bunch of groups higher? And what does the ongoing health look like? There's Facebook making a new all-time high yesterday. On the TSX also, has been very constructive. In fact, has been outperforming the S&P over recent months based on some of the sector weights. Of course, financials and materials being big groups within the TSX, certainly a good position in industrials as well. And when we look at the TSX in our positions, CGI Group in the tech services group, outsourced tech services, making a new high today and certainly acting better. But it's not all tech. We've got Advantage Oil and Gas making new highs. We've got Precision Drilling making new highs. So certainly energy, which we've talked a lot about, continue to act quite well as we head into the July 4th weekend. And in the financials, CI has had a pretty good week after consolidating a little bit. So a number of the names in financials, a number of the names in technology, a number of the names in energy acting quite well. So we're going to push this around a little bit today. When we get to commodities, we know that we broke out of a bear market. This is the Rogers Commodity Index of equally weighted commodities going back to 2008. We took out the highs early this year, and we've been month by month slowly working our way higher. In fact, if you look at it a little closer, you can see that commodity prices have basically been consolidating after this big run since May. We've run up 2 or 3 times into these levels. And within commodities, the metals have pulled back a little bit. The forest products have pulled back a little bit, certainly within trend. But there's nothing to make us think that this is anything other than sort of early stage bull market for commodity prices. On the long end of the bond market, we know that the TLT, or the 20 to 30 year US Treasury bond ETF, after quite a sharp move lower, has been consolidating really since March. And we talked over the last few weeks about running into these declining moving averages. That's the 150-day moving average. This is the 200-day moving average. And we bumped our head here about a week ago. We'll see what happens. My guess is the trend is probably lower. And there's a few clues that we can take away to help us look at that. When we look at the 5-year yields on the US 5-year bonds, it's actually hovering near highs. So while the 30-year bond yields pulled back a little bit on the more recent moves by the Fed or discussion points by the Fed, there is a view that they may be a little more hawkish. They may be a little closer to either raising rates or tapering their bond purchases, and the 5-year really notice that. The other thing that stands out, of course, is just the price pattern for the utilities index. And the utilities index we call a bond proxy because it's a high yielding group of utility companies with not a lot of growth in general, but high dividends. They tend to act a lot like the bond market. And despite the fact that the Treasury bond has rallied a little bit, the utilities really have not. In fact, they made relative strength new lows today versus the S&P 500. So that's a clue that I would take away to say that while the bonds have stabilized, that's a good thing. It's not that we are setting up for some kind of economic slowdown, or you would expect to see these defensive stocks, utilities and telcos and consumer staples rallying versus other groups, and just simply not the case. US dollar index, after pulling back, has been testing this. We've had a series of lower highs on each rally attempt. We'll see whether, in fact, it can push through. As it stands right now, we are in a downtrend. The moving averages are working their way lower. And so, weak dollar assets have been quite strong since last November, but certainly consolidated over the last few weeks while the dollar has rallied a little bit. My takeaway from that is that one of the groups that tends to do well with a weaker dollar is emerging markets. And the emerging markets ETFs this week, EEM and PIE, which is a momentum group of emerging market stocks, breaking out to new highs. So between utilities, at relative strength, new lows versus the market, and emerging markets, which clearly are a risk asset, breaking out to new highs. Hard to imagine that the market's telling us that there isn't oomph in the business cycle. It's not telling me that the bond market is telling us that there's some kind of a slowdown coming. There's frontier markets, which is even a little further out the risk curve than the emerging markets, and also very, very strong. So lots of news this week at a quiet time in the summer. A few things to talk about. Certainly, we had some mixed economic data. We had employment data that came in last week with unemployment claims a little higher than expected. We had GDP, capital goods orders coming in a little bit lower. We had Consumer Conference Board confidence index came in at 127, was expected to come in at 119. So, outperform, but certainly consumer confidence is coming back nicely as we work our way through the year. That's important. And there's quite a number of high frequency data points that we follow. And I've asked Jim Skatakis to come on and just talk a little bit today about what we're seeing in the recovery in the high frequency data. Jim?
Thanks, Dave. When we look at the chart on the left, we can see that the U.S. in the middle line, the blue line, is right back to pre-COVID levels in terms of seated diners. Florida, where Pam is doing considerably better.
Well, that figures.
And New York is rising fairly rapidly. And in talking to some people there, the streets are busier. Everyone is getting back into the swing of things. And then on the chart on the right, the TSA data shows that we're pretty well back to pre-pandemic levels.
So certainly a little bit better than the data we're seeing in Canada. We're a little bit behind, but the trajectory is.
The trajectory is similar, but we're not back to pre-pandemic levels. Yeah. And the TSA data is more it's more leisure travel as opposed to business travel. So there's room to go.
Yeah,
there's considerable room to move higher.
Also, there was a little bit of office data out.
Yeah. So when we look at the chart on the right, hotel occupancy back to pre-pandemic levels, roughly. And again, that's not the business traveler, but the vacation travel. But when you look at the chart on the left, office occupancy, even in places like Dallas and LA, and obviously New York City, is down to between 20 and 40%. So there's still some room to improve, and certainly we're seeing some employers indicate that they would like to see their workers back. JP Morgan has said that they'd like everyone back in the office, vaccinated or unvaccinated in different formats. And Morgan Stanley has said they want everyone back in the office by the middle of July. Anyone who has 2 vaccines can be back in the office, and anyone who isn't can work from home. So they're trying to get everyone back.
Now, this past week, there's been lots of discussion about a potential infrastructure deal, and it is a little bit confusing as to what might happen, what kind of agreement there could be on a bipartisan basis. What's your take on it, Jim?
Well, it looks like we've got 5 senators from the Republicans and 5 from the Democrats who come together and come up with a deal that doesn't satisfy anyone, but has a chance of getting through. There's a little bit of everything, as you can see in the chart. There's obviously something for roads, for transit, electrical vehicles, water, sewage, airports, ports, etc. So there's stuff for everyone. And the administration is keen on getting something passed. And, you can call it around $600-700 billion. There are other ways of slicing it where it looks like it's more than $1 trillion, depending on whether you include the spending that's already been approved. And what I know, I was speaking to someone earlier, and they made the point to me that there's an election coming, a midterm election coming in about a year and a bit. And can you point to a politician who doesn't want to spend money ahead of an election? So there's some impetus to get this done, and there's some very worthwhile projects as well. So it probably takes until August, September to get it through, but I think the chances are quite reasonable.
Okay.
Very encouraged.
So certainly not a bad thing for some of the more cyclical groups.
Yeah, no.
Just to back up to some things that happened yesterday. We've been talking about the Fed's ruling on the stress tests on the banks and their capital ratios. Maybe you could give us a little bit of color on that and what that might mean for dividend growth and share buybacks.
Okay, so the Fed does a stress test on the banks once a year, a comprehensive capital analysis and review. And what you can see here is that the banks have in the dark lines are doing much better. They have exceeded their expected capital ratios. So, and in talking to some of the banks, they say, well, the Fed does this once a year. We do it 12 times every 2 weeks, just to make sure that we know where we're going. So there's no surprise that everybody passed, and they've generated a lot of excess capital. And that's also not a surprise, given that, a year ago or more, everyone was expecting that there would be credit issues, and the banks were busy trying to build capital. So some of them cut their dividends, some of them postponed their dividends. Certainly they stopped buybacks. They were directed to stop buybacks by the Federal Reserve, and so they built capital, and now they're being allowed to. We can see that they've generated a ton of it. And the credit environment has been pristine, largely because of the largesse of the Treasury and flooding the system with money. There have been no credit defaults to speak of.
What might it mean for dividends?
So dividends are the banks just yesterday announced that dividend increases are coming in a fairly big way, and the biggest surprise came from Morgan Stanley. Everyone thought dividends were going up, but Morgan Stanley doubled their dividend. So they went from 1.5% to just over 3% dividend yield. Goldman Sachs increased their dividend by 60%. And JP Morgan, who's the largest bank, increased by over 10%. So we're seeing, large capital returns, and dividend increases speak to more confidence in your business model. So Morgan Stanley took their dividend to 40% of earnings. So they're reasonably confident they can continue to do this. Because remember, you never want to be cutting dividend. Right. That's a real negative in the market. So this shows extreme confidence in business model, and rightly so. They've done a great job.
That's great. That's great. Well, it's always interesting. We talk a lot about dividends and share buybacks, but I was noticing this week that the U.S. commercial loan asset loans and leases have quietly started to grow again. And that's been one of the knocks on the banks, that they've been unable to grow their loan books. Certainly some of the banks that we're focused on have much higher growth rates, but as an aggregate group, they've had a hard time. So that'll be interesting to see as well. Thanks so much, Jim, for joining us today. There's the IAI, which is the broker dealer ETF, and you can see after pretty good pullback from early part of June, back above all the moving averages and working their way back higher. So as it sits right now, let's talk a little bit about our indicators. Our long-term breadth models continue to be positive, although it is not with a completely clean bill of health. US breadth models improved a little bit this week. Global breadth models were about flat. Canada was about flat, but under the surface, there's a few things that we're watching. Just wanted to highlight. The S&P is making new highs, but when the S&P was making new highs in January, almost 85% of stocks were trading above their 50-day moving averages. As we sit today, we're now below 50% of stocks trading above their 50-day or sort of short-term moving average. Also, percent of stocks trading above their 150-day moving average is still very, very good. It's still around 70%, but it has come down a little. And the percent of stocks hitting new highs versus new lows has backed off a little as well. This could just be squaring up at quarter end. We know that there's been some rebalancing because the value-oriented sectors have done so well relative to growth, and growth is seeing a little bit of a resurgence. So you're seeing, tiny little bit of rotation, but that's something certainly we want to watch. And just to put a point on that, this is the percent of stocks trading above their 50-day moving average. In fact, 2 weeks ago, it was considerably lower in the S&P, and it has been bouncing back here. So something we certainly watch, but our big indicators continue to tell us that breadth is in decent shape. And we know that June, I think 20 out of the last 23 Junes have had some bumpiness, but July tends to have some summer rally written on it. So we'll see what things look like as we get through the quarter end noise. As far as geographic regions go, the vast majority of global equity markets are showing improving breadth. So we think we have a pretty good backdrop for equities as a whole. The credit indicators continue to be very good. Credit spreads for investment grade bonds are basically sitting at multi-year lows, meaning that bond investors are not demanding a premium yield to take credit risk. And similar for high yield bonds, or what some people might call junk bonds. Again, the credit spreads are very low. So credit markets seem to be quite calm. The one more point that I wanted to point out is we have seen a sharp uptick in the number of credit upgrades on a quarterly basis, and we're at multi-year highs in improvement in quarterly in credit upgrades. So credit markets are kind of giving us a green light. From a volatility perspective, we've seen lots of little spikes. This was quite a big one in March as the pandemic got underway. We've seen a number of spikes since then, generally lower highs, and we're sitting now down around 16, which is sort of a sweet spot for equity markets. Best returns tend to come when volatility is below 18, and we are there right now, even though we are seeing headed into quarter end. Just talk a little bit about leadership. Not a lot of change. I've been putting this up over the last few weeks. This takes November the 1st as a start point, because this is really where the current leadership kind of kicked off. And energy has been by far the best performer. But if we go from the bottom, interesting, even though the bonds have brought a little, utilities are bringing up the rear with negative returns. The consumer staples ETF, not much better, and global infrastructure. So these are bond proxies. You can see there's no real pickup in strength versus the S&P. So that tells me that the defensives are not taking over. This red line, I know it's a little noisy, but is the growth, the S&P growth index, and it has been picking up some ground versus the S&P itself, but still underperforming since November. And then outperforming the S&P since November, industrials, emerging markets, consumer discretionary, a dividend growth cohort, which we've talked a lot about. Dividend growth continued to look quite attractive. Financials, metals producers, and of course, energy. One thing we'll watch over the next couple of weeks is how energy performs coming out of the July 4th weekend. There is some seasonality around July 4th. Sometimes it's kind of buy the rumor, sell the news. So we'll see whether the energy stocks can maintain their strength. They could probably pull back a little bit. But when we look at the overall theme, and I stole this chart from Twitter this week, this is relative performance of growth versus value. So certainly growth has had a little uptick in the last few weeks, but really we've just rallied back to where we broke down. So we'll see, does this follow through? We're just underneath the 200-day moving average for that ratio, or will it roll back over? My sense is that the real strength is in cyclicals. We are earlier in that phase, and while they certainly can have a pause, we've put this up a few times. the growth versus value got so extreme recently, and just like it did in the late part of the 1990s. So I'm guessing this is probably not over yet, but we'll see. As far as technology goes, technology is making new highs, but the relative price performance versus the S&P continues to make lower highs. So I think that that's something that's worth watching. It causes us not to want to jump in there with both feet. As you know, we have a underweight exposure to technology currently. And there have been some redemptions, which have been unusual, but some redemptions coming out of some of the tech funds. So, there is some rotation taking place. Now, as far as earnings momentum goes, coming into the next quarters coming up, energy earnings momentum is very, very strong. Industrials and materials. So these are probably the strongest group. That is probably a bid to the cyclicals. So we've got some cyclical groups that have pulled back into moving averages. We've got some growth that has reaccelerated. None of them are breaking down. So that tells me that breadth overall, sector to sector, is good. And the long-term indicators continue to be positive at what is often a tricky few weeks coming into the end of June. Just to put a bow on that, our job is to do three basic things. Okay? Our number one job is to identify market-leading themes and focus our attention there without a bias. We run our breadth models every day. We look for new improvements in breadth so that we can spread the portfolio over more groups and reduce our risk. Where we do see new leadership, we will adjust the portfolios, and where we see a deterioration in breadth, either at the sector level, at the market level, we will get more defensive when it's required. As it stands right now, we're pretty fully invested. Tactically speaking, I think that the market has been digesting the gains from late fall and early winter. The people have made note of the fact that we haven't had a 5% correction in quite some time. But when you get into a bull market, that can go on for longer than you expect. Last week, we talked about the fact that we had just taken our overweight and financials down slightly, and we had been bumping up our energy weight. We also had taken our industrials exposure down slightly, and we had rebuilt some technology weight. If we fast forward again to this week, this is an iterative process. You'll see that technology, again, has been bumped by 2-3% over the course of the week. Energy continues to perform, and so organically, it's been growing in weight. We've added a little bit more. Again, financials taken down slightly more, but still a very significant 3 times market weight in financials. And industrials came down a little bit this week. So we're not making a lot of trades. There's a lot of noise in the market, little mini rotations, but we aren't seeing anything at this point that causes us any major concern. When we look at the Canadian dollar, still firmly in an uptrend. Certainly it pulled back, as things do when they get extended away from moving averages, but we think that that is something that likely to continue. And just back again to the SPDR. Look, SPDR's had a good week. It has certainly been helped by some large cap tech stocks, and we watch every day for signs that this might be coming to an end. But the reality is, we've got a good stretch going. This is a chart that shows the consecutive number of months of positive momentum over time. So we've had 12 months of positive momentum in the S&P, and we go back over time. That is a pretty good run, but it doesn't mean it can't be longer. Okay, this is 2002. This is 1988. 18 months, another 6 months beyond where we are now. So what we're looking for in the very short run is a little bit of strength through July. We're always cautious when we're coming into August and September. So we'll watch closely our indicators to see what changes. But I thought you'd be interested in this data. This goes back to 1929, and here we are pretty much done the first half of the year. When you took every year where the market was up 10% or more in the first 6 months, while lots of people will say, well, maybe it's going to revert to the mean and pull back, actually, when you take all of those years back to 1929, 1, 2, 3, 4, 5, 6, 7 years, had negative second halves. And in fact, if you took all of those years and then looked to see if any had a second half bad enough to wipe out the first half, only one, and that was 1929, very different climate than we're in today. So look, strong first half tends to bring a strong second half. Our models are solid. We watch every day for signs of weakness, either at the group level, at the asset class level, or the geographic region. But as it stands right now, we're pretty fully invested. We will get defensive when things get sloppy. We've shown that in the past, but as it is right now, forward we go, and we make little adjustments along the way. So with that, Pam, if there's any questions, maybe we can answer them.
Yeah, thanks so much, Dave. We have a question here from Osler Bluff, Collingwood. And the question is, did the rebalancing of the Russell indexes last week have an unexpected impact?
It had some impact for a couple of days, but nothing too significant. Some small weight changes. We are a little bit more large cap focused. The mid cap and small cap bullish percent models have been a little bit sloppy for the last month and a half. So we really haven't been putting on a lot of small cap positions. So less relevant to us. But always when there's rebalancing, it moves the chairs around a little bit.
Thanks so much, Dave. Next question. Are you concerned that the advanced decline line is not confirming new highs in the S&P 500?
Yeah, look, it's very similar to looking at, the percent of stocks trading above their 50-day. We know that we prefer markets where the returns are coming from a broad base of securities. And as we talked about, early on, the S&P and the NASDAQ have gone on to make new highs with fewer companies trading above their 50-day. And as the viewer mentions, fewer stocks making new highs. Now, that would be typical if you're seeing some internal rebalancing in the market. I think that optimism got pretty strong in some of the cyclical groups. They got extended away from the moving averages, so they pull back a little bit. But in the vast majority of them, they're trading above all their long-term moving averages and have positive trends as we define them using point and figure price charts. So I'm not so fussed about that. I would rather see sort of some internal dynamics and chopping sideways than a big price pullback in the index. I'll take that any day. And that's really what we've been seeing over the last 60 days. That's from what I can see so far. If the long-term breadth model started to turn down, we'll take that more seriously. But I think that the market's just digesting.
That's great. Well, thanks so much, David. And Jim, thank you as well for joining us this afternoon. That concludes the questions that we've received so far to date. And with that, I leave you with the final word, David.
Look, I hope everybody has, south of the border and north of the border, a great holiday weekend. One thing that we've learned, don't trade too much when the volumes are down. It can really only serve to hurt you. And so unless there's really something to do here, we think that we're better just to sit tight. And we'll talk to you again. We will miss next week, but we'll talk to you again the week following. I think it's going to be kind of a quiet week next week. So thanks everybody for joining in.
Thanks, Dave. Thank you, Jim.
Thanks, Jim.
Thank you.